stocks, exchange-traded fund, or ETFs, index funds, and mutual funds. You've probably heard these terms before. They're the most common doors into the stock market. But if you're just getting started, which one should you actually choose? In this video, I'll break down each of these investments in a clear, simple, and practical way. We'll break down stocks, ETF, index funds, and mutual funds, what they are, how they differ, the risks involved, the fees you might pay, and which one might be right for you. Watch till the end to know which path makes the most sense for your investing goals. But first, a quick disclaimer. This is not financial or investment advice. All right, let's begin with, what are stocks? A stock is simply a share of ownership in a company. When you buy a stock, you're essentially buying a small piece of that business. For example, imagine Apple as a giant pizza. Each share of Apple's stock is one slice of that pizza. When you buy a share, you own that slice, meaning you literally own a fraction of Apple itself. Now, why do companies even sell stocks? Because they need money to grow. When Apple, Nike, or Netflix wants to build new stores, launch new products, or expand globally, they raise money by selling small pieces of ownership, called shares, to investors like you. In return, investors have the opportunity to benefit from the company's success. You can make money from stocks in two main ways. 1. Price growth, when the stock's price rises and you sell it for a profit. 2. Dividends, when a company shares part of its profits with shareholders, usually as cash payments. What are the fees for trading stocks? In the US, most brokers no longer charge commissions on stock trades, so buying and selling is usually free. You might still pay small regulatory fees or lose a few cents due to the bid-ask spread, but overall, trading stocks today is cheaper and more accessible than ever. Now, let's talk about the risks involved. If the company struggles or the market turns negative, the stock's price can drop. That's why stocks are considered high-risk, high-reward investments. Their prices move every second during market hours, driven by news, earnings, and investor emotions. Here's what you really need to remember. Stocks are the foundation of everything else in investing. ETFs, index funds, and mutual funds. They all contain collections of stocks inside them, so understanding stocks helps you understand every other type of investment. Now that you've learned what stocks are, not everyone has the time or interest to research individual companies or track stock charts every day. That's where funds come in. There are three main types you'll hear about: exchange-traded funds, index funds, and mutual funds. But before we dive into each of them, let's first understand what a fund actually is. A fund is basically a basket that holds many different stocks inside it. When you buy one share of a fund, you instantly own tiny pieces of all the companies inside that basket. Think of it like this. Instead of buying one single fruit, like an apple or an orange, you're buying a fruit basket that already contains a mix of everything: apples, oranges, grapes, and bananas. In investing, each fruit represents a company, and the basket is the fund. That means even if one company performs poorly, the others inside the basket can help balance things out. This built-in diversification is what makes funds so popular, especially for beginners. All right, now let's discuss the three most common types of funds. Let's start with ETF, short for exchange-traded funds. An ETF is basically a basket of investments, usually made up of dozens or even hundreds of stocks, that you can buy and sell just like a regular stock on the stock market. That means it trades throughout the day, and its price moves up and down as investors buy and sell shares. So, imagine you want to invest in America's biggest companies: Apple, Microsoft, Google, and hundreds of others. Instead of buying each stock separately, you could just buy one ETF that already includes all of them. With a single purchase, you instantly own small pieces of every company inside that ETF. That's the beauty of it: instant diversification. minimal effort. ETF are designed to follow a specific index, sector, or theme, kind of like playlists for your investments. For example, S&P 500 ETF tracks the performance of the 500 biggest U.S. companies. Vanguard Total Stock Market ETF gives you a piece of almost the entire U.S. stock market. And the best part? There's an ETF for just about everything, from tech and clean energy to real estate and beyond. ETFs usually have very low fees because most of them are passively managed. That means no one is constantly buying and selling inside the fund. They simply mirror an index. This keeps costs down for you as an investor. However, like any investment, ETF carry market risk. If the overall market drops, your ETF value can drop too. But for most long-term investors, they're seen as one of the easiest and most cost-effective ways to build wealth. What are index funds? Before we talk about index funds, let's first understand what an index actually is. An index is simply a list or collection of companies that represent a particular section of the stock market. For example, the S&P 500 is an index made up of the 500 largest publicly traded companies in the United States. An index is like a scoreboard that tracks how a group of stocks is performing. All right, let's talk about index fund. An index fund is a type of investment fund that's designed to track the performance of a specific market index, like the S&P 500, NASDAQ 100, or Dow Jones Industrial Average. So, when you invest in an S&P 500 index fund, you're not buying a single company. You're buying tiny pieces of all 500 companies at once. That means instant diversification. Your money is spread across many industries, reducing risk compared to holding just one stock. How index funds work. Before we move on, there's one key thing you should know about how index funds actually work, because it's a little different from buying regular stocks or ETF. When you buy a stock or an ETF, your trade happens instantly during market hours, and you can see the exact price you're getting. But with index funds, it doesn't work that way. Index funds are only priced once per day after the market closes. That price is called the net asset value, or NAV. It's calculated by taking the total value of all the assets the fund owns, subtracting any expenses, and then dividing by the number of shares in the fund. So, for example, if you place an order at 11 a.m., it won't execute immediately. Instead, your trade will go through at the NAV that's calculated after the market closes, usually around 4 p.m. This is known as the cutoff time. If you place your order before that cutoff, it'll be processed that same day. If it's after, it'll go through the next business day. This system keeps index funds simple and consistent, but it also means you don't have real-time control over the exact price you'll get. To give you some examples, some of the most popular index funds in the U.S. include the Vanguard 500 Index Fund, the Fidelity 500 Index Fund, the Schwab S&P 500 Index Fund. Index funds are passively managed. Because there's no manager constantly trading inside the fund, so fees are usually very low, which is great news for beginners. Like all investments, index funds do carry market risk. When the market goes down, so does your fund. But the difference is that over decades, indexes like the S&P 500 have historically grown significantly, even after market crashes. In short, index funds are the ultimate set-it-and-forget-it investment. Simple, low cost, and proven to grow with the economy over time. Now you might be thinking, aren't ETF and index funds basically the same thing? They do sound similar, but there are a few key differences that really matter. Let's break them down. ETF are traded on exchanges like a stock throughout the day. Index funds are bought or sold only once per day after the market closes. ETF prices fluctuate throughout the day in response to changes in supply and demand. while index funds are priced once daily at net asset value after market closes. ETF can be traded instantly during market hours. On the other hand, index fund trades happen only once per day after the market closes. ETF are best for investors who want flexibility and control over timing. On the other hand, index funds are best for investors who prefer simplicity and automation. What are mutual funds? Now, let's talk about mutual funds, one of the most popular and traditional ways people have invested for decades. So, what exactly is a mutual fund? A mutual fund is a large pool of money collected from thousands of investors that's managed by a professional fund manager. This manager's job is to actively pick and choose which stocks, bonds, or other assets to buy and sell inside the fund, with the goal of beating the market. In simple words, you're hiring an expert to make investment decisions for you, and you're paying them a small fee for that service. Let's take a simple example. Imagine you and a million other investors each put $100 into a mutual fund. That creates a big pool of $100 million. The fund manager then uses that money to buy what they believe are the best stocks. Maybe some Apple, some Tesla, some Johnson & Johnson, depending on their research and strategy. If those investments perform well, everyone in the fund benefits. If they don't, everyone shares the loss. There are actively managed mutual funds, where a manager tries to outperform the market, and passively managed mutual funds, which simply follow an index, similar to an index fund. Now let's talk about the fees and risks involved. Because mutual funds are managed by professionals, they tend to have higher fees than ETFs or index funds. These fees are called expense ratios, and they're usually deducted automatically from the fund's returns. While professional management sounds great, here's a reality check. Most actively managed funds don't consistently beat the overall market after accounting for fees. That's why many modern investors prefer index funds or ETF instead. So which one should you choose? If you enjoy learning about companies and don't mind risk, start with stocks. If you want control and diversification, ETF are a great balance. If you want to invest long-term and keep things simple, go with index funds. And if you want professionals to handle everything, mutual funds might suit you. Remember, there's no single best choice, just the one that fits your goals, time, and comfort level with risk. So now that you understand how stocks, ETF, index funds, and mutual funds work, the next step is simple. Start small and stay consistent. If you found this video helpful, don't forget to like the video, share your thoughts in the comments, and subscribe for more content. Thank you for watching.